Navigating China's regulatory tsunami. Mounting uncertainties over wide-ranging regulations in China is leading to significant volatility in Chinese stocks. The question investors are asking is, how should I navigate this environment? China seeks to fulfill its ambitions as an economic and technology superpower and to transition from an export-led growth model to achieving more sustainable and high-quality growth. To do so, the government is aggressively addressing a mix of critical challenges related to excesses and weaknesses in various markets and sectors, an aging workforce, and tensions with the United States. On one hand, in addressing these challenges, the broad direction of China's policies has been fairly sound and consistent. For example, in the technology sector, where network and scale effects often accrue overwhelming market power to the leading players, regulations against monopolistic practices and to protect consumers are sensible. China's efforts in this area are not dissimilar to the US and European Union's antitrust efforts to keep tech giants in check. The key difference is that under the China model, we can see results in months instead of years. On the other hand, we need to recognize the consequential trade-offs and risks posed by China's regulatory actions. Investors value a steady operating environment underpinned by market-oriented policies. The sharp hit to private education businesses has raised doubts over the role of private capital in terms of the balance between the profit incentive and social equality, as viewed by China's policymakers, and whether this equilibrium is subtly shifting. In the extreme scenario of prolonged investor uncertainty, it could increase risk premiums, depress asset prices, and hurt the ability of Chinese companies to raise funds. Bottom line, overall, the good news is that the ongoing volatility is unlikely to impact China's macroeconomic outlook significantly. Regulatory uncertainty, however, is likely to weigh on investor sentiment over the near to medium term, and investors will need a new roadmap for investing in Chinese stocks in the months ahead. We're cautious that Chinese stocks listed in the US, also known as ADRs, especially those in sensitive technology and data-intensive sectors, could see further volatility as both US and Chinese regulatory pressures loom large. In contrast, we favor sectors that are key to Beijing's long-term strategic goals, as highlighted in its 14th five-year plan, such as AI, 5G, renewables, infrastructure, and new energy vehicles, as they're slated to receive increased government support.